Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Like the name of the show suggests, this show gets you everything that you need to know about your personal finances. And to that end, we speak about mutual funds, sometimes your investments in other products and asset classes. We also talk about your expenses and borrowings and various other aspects. If it has to do with money, it's covered on this show. On today's program, I'm going to talk about small cap mutual funds because in the recent past, and particularly over the last 1 year, they've not done too much. In fact, the benchmark small cap index is in single digits if you compare it with where it was a year ago. The question that we're asking though is, have actively managed small cap funds managed to beat the benchmark consistently, and how have the top performers managed to outperform the rest of the pack so convincingly? And we'll also talk about whether these outperformers of the last 1 year have indeed outperformed over the last 5 years as well. We'll also talk about loan against mutual fund, why you should use this product and what you should not use it for. That's in the second half. To talk about small cap mutual funds though, I'm joined today by Megha Malpani, who is a CFA and partner at Zvest Financial Services. Megha, thanks so much for taking the time. Let's first set the context and talk about how small cap as a category has performed over the last 1 year.
Right. Thank you, Alex. Thank you so much for having me here. So as we speak, there are 31 small cap funds that exist in the industry, and 29 of them have been around for a year. As you rightly said, the BSE Small Cap Total Return Index has given a return of close to 2.5%. However, if you look at the fund returns, they have been to the tune, the excess return, which is the return over the benchmark, has had a wide dispersion from 0.5% to 12%, which means that and the number of funds which have actually beaten the benchmark is 18 on 29, which is a close 62%, which means that active funds have done a good job. To my mind, this is like running a marathon on a very hot day. The overall pace has been slow. Some active managers have managed to move ahead of the benchmark, by a few steps, and some with a very strong lead.
And that's a very good analogy to make, because ultimately this is a marathon. But Megha, if you were to talk about the top 3 performers, what has stood out about them? Because the alpha that they've generated is very substantial. Even over that 1 year period, 12 percentage point beat for the top performer is something that you don't very often see.
Right. So, Alex, for this question, let me take a threshold of AUM of at least 5,000 crores to have a fair comparison. So, if you look at these portfolios, and probably let's draw an analogy with 3 chefs trying to curate a recipe for you. So the recipes are, the ingredients of the same are of very high quality, which means that, we have deep bottom-up research, disciplined stock selection, and they've stayed invested for a long term, which has actually proved to do well for them. However, after this, the strategies start diverging. If you talk about the 3 funds which have been the top performers, they are Motilal Oswal, Invesco, and Bandhan. Now let's dive deep into each of these funds. Now, from a sector positioning standpoint, all of them have a higher share in the healthcare sector. If you talk about Bandhan and Invesco, they also have a higher share towards financial. Motilal, very interestingly, has a higher share towards electrical equipments. Now, if you talk from a portfolio construction standpoint, Motilal and Invesco run more tighter concentrated portfolios where they have close to about 65 to 70 stocks. Bandhan, if you believe me, has close to about 237 stocks. And 150 stocks out of them have a position sizing of 0.5% or less. So, it's kind of giving many, many flavors to the recipe, right? And which means that it has a very, very long tail, which alters the risk profile of this particular fund. If I talk from a valuation and cash management standpoint, Bandhan again stands out because it has one of the lowest portfolio PEs in the industry. And also, it has the highest cash position at close to about 10%. However, if you talk from a small cap pure play purity standpoint, I think Motilal Oswal, steals the show there with close to about 77% of its holdings into small cap, whereas Bandhan and Invesco are below 70%, and the mandate requires them to have close to about 65% in small cap holdings. So the long story short, the philosophy is the same. However, the recipes differ in terms of presenting it to the investor.
Okay, that's well put. Would you say that in the small cap space, if you have a larger number of stocks, and you see this generally, in my experience, in schemes that have a very large AUM, because naturally, if they have to stay small cap, they have to increase the number of stocks that they invest in, because the investable pool in each of those stocks is limited. So if you talk about a 10,000 crore market capitalization or a 5,000 crore market capitalization, if you're talking about a Nippon small cap fund, which has 50,000 plus crore of assets under management, if they have to deploy 1%, then they wouldn't be able to do this in the 5,000 crore market capitalization company. So they would have to have a large number. But do you think that that also limits the downside to a large extent compared with more concentrated portfolios? Because you would have to have a market-wide drop in the stock market for these schemes to see a very sharp drawdown.
Right. So, as you rightly said, Nippon and Bandhan, have that kind of number of stocks. And Nippon is actually now close to 70,000 crores. It used to be part of our recommended list for the longest time possible. It probably alters the, risk profile because they take larger recourse to large and mid caps, definitely, Alex. But I think the problem is it doesn't stay true to the label. So for the investor who is coming to invest in a small cap, it actually becomes more like a flexi cap to my mind. It, of course, depends on the investor. If he's all right with it, he can go ahead with it. But in spite of all of it, it has given stellar returns in the past. You cannot deny that and take it away from them.
Okay, fair point. Now, the question therefore arises, these three schemes that you've mentioned have done incredibly well. But are they consistent performers over the longer period, say 5 years? Because ultimately, you would judge a fund manager and a scheme performance over the long term, and I think a lot of advisors, I think including yourself, would say at least 3 years is the track record you would need.
Right. So if you look from a 5-year standpoint, there were 21 funds that existed in the 5-year space. And Quant, Nippon, and Invesco used to lead the charts. If I look at it from a 3-year lens, again, these funds have been among the top 5 performers. However, if you look from a 1-year standpoint, Motilal Oswal has, kind of come in. And it is important to mention here that Motilal, is not even completed 2 years of its existence. Quant and Nippon have actually slid down the list. So, to my mind, as you very rightly said, from a 3-year and a 5-year period, these funds have remained consistent and done well. But again, it's like you cannot judge a test match just by seeing the first hour of play, because it depends on the pitch. You have to see the entire course of 5 days to understand how, how the players are performing. And also what happens, if you're kind of looking at trailing returns from a 1-year point of view, they can get skewed by a very strong or a weak year, and which can kind of dilute the entire returns that you're probably seeing. So it is also important to look at these returns from in conjunction with time period returns. And also what happens, Alex, I think is that, because small caps can generate that kind of an alpha, it is also important to understand the risk control frameworks and the quality of the fund management before deciding which small cap fund to invest in. However, if I see from a 3-year to 5-year standpoint, yes, these funds have been consistently performing. Invesco has been there in 1, 3, and 5-year period.
Okay, all right. So bear in mind, of course, that you need to look at a longer time frame. And also, by the way, in our show yesterday, Megha, we discussed a few parameters that you can look at beyond returns and rolling returns. We spoke about standard deviation. We spoke about your downside and upside capture ratio, and also the Sharpe ratio. So these are things that might just help you identify your best fit when you're looking at your portfolio. But let me ask you this. As of November 2025, based on what you know right now, considering that you've seen an underperformance, relatively speaking, over the last 1 year, what are you advising people to do with regard to their small cap allocation? And how do you select a good scheme?
Yeah, so I'll take the second question first as to how do you select a good scheme? As I said, we always look at performance across market cycles. Good performance in a good market comes to most fund managers, but during periods of drawdown, volatility, we check what is the recovery speed, because I think that is very, very important to a retail investor. We also look at, as I said, fund size and liquidity, which we discussed earlier. We also look at the quality of the research team, because if you understand, anything beyond the 251st stock is potentially a small cap company, and there is very limited sell side coverage. In-house research capabilities are limited. So we do not like teams which are not kind of supported by a good enough number of research analysts, because here depth matters as much as breadth does, right? We also look at balance between concentration and diversification, because too concentrated portfolio can kind of increase the risk profile, whereas too diversified fund could actually get the returns diluted to a large extent. So yes, we also look at true to label funds, as we were discussing a while back, because too much of large or mid cap exposure can defeat the purpose, and we do not like too much of benchmark hugging either. So keeping these in mind, yes, I think small caps are now a part of the core portfolio. If you look at some of the companies that exist in the small cap space, some of them are category leaders. Some sectors have no representation in large and mid cap space. Just to share a very interesting perspective with you, Alex, in 2018, 2019, when the categorization happened, the 251st stocks market cap used to be 8,000 crores. Today, as we speak, it is almost 33,000 crores. So the definition of small cap has also changed. And I think small cap deserves a position in every portfolio. I do not think that, if you have a 7 to 8 year time frame, you can construct a portfolio excluding small caps.
Okay, important points that you raise. But Megha, let me ask you this. Is there a list of schemes that you like? And you explained why you no longer look at Nippon, for example. Even though they've done well over longer periods of time, they're simply too large to have that true to label bill right now. So what is your list right now?
So, as I said, we have not kind of redeemed from Nippon, but we're not doing any incremental allocations to Nippon. Given all the checklist that I mentioned to you, the funds that we are kind of recommending in the small cap space, which fit into all the criteria, include Bandhan, HDFC, and Invesco, because in terms of processes, portfolio construction, consistency, they are all doing well. And very interestingly, all these three funds are managed by the chief investment officers of the respective fund houses, which probably adds some layer of stability and oversight to the fund.
Okay. The last point, which I think is an important one to address, the tendency, Megha, for the average investor is to build their portfolio as multiple blocks, and anything that looks attractive in the near term gets added to the list. Sometimes it's by stopping an existing SIP and switching it and not redeeming that earlier investment. So the tendency is to have multiple schemes in the same category. Is it appropriate to do that in the small cap space?
Yes, I think it is extremely important to at least have two funds as far as small cap is concerned, Alex, because two different fund managers can actually run two very different portfolios, right? Because we spoke about how, the stocks that are available, how under-researched they are, right? Some of them are like hidden gems, and, they have to be discovered. Also, the fact that, fund houses differ significantly in terms of research depth and the volatility which is inherent with small caps. I think it is important to at least have two high quality active funds in the portfolio to hedge manager selection risk.
Okay, fair point. And important. I think we've covered quite a bit of ground on this conversation. Megha, thanks so much for taking the time. Pleasure speaking with you as always, and look forward to the next one.
Thank you, Alex. Thank you so much for having me here.
All right, so that's quite a bit of what you might have wanted to know about small cap mutual fund schemes. Let us know if we covered the schemes that you currently own, or if there are schemes that you own that you'd like us to talk about.